Welcome to a new video where we delve into the exciting world of high-yield dividend ETFs. Today we're on a journey to explore a powerful tool in the realm of investing, exchange-traded funds or ETFs for short. And not just any ETFs, mind you, we're talking about those with high yields and dividends, the kind that are designed to generate a steady stream of passive income. Imagine having your money work for you while you sleep, or while you're off enjoying your favorite hobbies. Sounds like a dream, doesn't it? Well, with the right investments, it can be a reality. That's the beauty of passive income, and high-yield dividend ETFs are one of the ways to achieve it. In the course of this video, we'll be taking a closer look at three specific ETFs. First up is SCHD, a U.S. dividend equity ETF that focuses on high dividend yielding U.S. stocks. Then there's JEPI, the JP Morgan Equity Premium Income ETF, which aims to provide option-enhanced equity exposure. Last but certainly not least, we have VNQ, the Vanguard Real Estate ETF, a fund that offers exposure to the U.S. real estate sector. So buckle up, folks. This is going to be a thrilling ride into the world of high-yield dividend ETFs. Stay tuned as we break down each ETF, its benefits, and why it's a good choice for passive income. Hello, viewers. If you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First on our list is SCHD, an ETF that has made a name for itself in the world of passive income. Let's delve into what SCHD really is. SCHD stands for Schwab U.S. Dividend Equity ETF. It is an exchange-traded fund that tracks the performance of high-dividend yielding U.S. stocks. These are typically companies that have a record of consistently paying out dividends to their shareholders, making it an attractive option for those seeking to generate a steady income stream. Now let's talk about SCHD's performance history. Since its inception in October 2011, SCHD has consistently provided its investors with a strong performance. While past performance is not indicative of future results, SCHD's track record of stability and growth is certainly worth noting. The ETF has managed to deliver an annualized return of around 6 to 7%, which is quite impressive when compared to the average savings account or government bond yield. But what are the benefits that SCHD offers to investors? Well, there are quite a few. First off, SCHD provides exposure to a diversified portfolio of high dividend yielding U.S. stocks. This means that instead of having to individually buy stocks from each of these companies, you can simply invest in SCHD and gain exposure to all of them. This makes it much easier to diversify your portfolio and reduce risk. Another benefit of SCHD is its low expense ratio. An expense ratio is essentially a fee that ETFs charge their investors. SCHD's expense ratio is just 0.07%, which is significantly lower than the average expense ratio of other ETFs. This means that more of your money goes towards your investment rather than being eaten up by fees. But what makes SCHD a good choice for generating passive income? The answer lies in its dividend yield. As we mentioned earlier, SCHD invests in companies that have a history of consistently paying out dividends. These dividends are then distributed to SCHD investors, providing them with a steady stream of income. This makes SCHD an excellent choice for those who are looking to generate passive income, whether it be to supplement their current income, save for retirement, or even fund their dream vacation. It's also worth noting that SCHD's dividends are qualified, meaning they are taxed at a lower rate than regular income. This can be a great advantage for those looking to maximize their after-tax returns. In conclusion, SCHD is an ETF that offers a number of benefits to investors. It provides exposure to a diversified portfolio of high dividend-yielding U.S. stocks, has a low expense ratio, and generates a steady stream of qualified dividends, making it an excellent choice for those looking to generate passive income. With its solid performance and attractive yield, SCHD is definitely an ETF you might want to consider. Moving on, let's explore JEPI, another high-yield dividend ETF worth considering. JEPI, short for JP Morgan Equity Premium Income ETF, is an exchange-traded fund that has been making waves in the investment world. This ETF, managed by JP Morgan Chase, one of the world's most reputable financial institutions, offers a unique approach to generating income. But how does it do this, you might ask? Well, the secret lies in its unique strategy. JEPI primarily invests in large-cap U.S. stocks, similar to many other ETFs. But what sets it apart is its use of an options strategy known as a covered call. In simple terms, JEPI sells options on its stock holdings. These options give buyers the right to purchase the stocks at a specific price within a certain period. In return, JEPI receives a premium, which is then distributed to investors as a part of its monthly dividend. This strategy allows JEPI to generate income in both rising and falling markets, making it an attractive option for those seeking a steady stream of passive income. But remember, while this strategy can enhance returns, it can also cap potential upside, especially in a strong bull market. Looking at JEPI's track record, it's clear that this ETF has been a strong performer. Since its inception in May 2020, JEPI has consistently offered a high yield, often outperforming many of its peers. As of December 2024, JEPI boasts a 12-month yield of over 7%, a figure that is notably higher than the average for U.S. large-cap ETFs. While past performance is not a guarantee of future returns, JEPI's success so far speaks volumes about its potential. The fund's robust performance is a testament to its effective strategy and the expertise of the team at JPMorgan Chase. Beyond its track record, JEPI offers several other advantages to investors. For one, it provides broad exposure to the U.S. stock market with a portfolio that spans across various sectors. This diversification can help to mitigate risk and smooth out returns over time. Moreover, JEPI's use of a covered call strategy can serve as a hedge against market volatility. This makes the fund a potentially good fit for investors seeking a more defensive play in uncertain market conditions. Finally, JEPI's commitment to income generation makes it a viable option for those seeking passive income. With its monthly dividend payouts, JEPI can provide a steady income stream that can be reinvested or used to cover living expenses. Of course, like any investment, JEPI comes with its share of risks. The fund's use of an option strategy, while potentially lucrative, can also limit capital appreciation in a strong bull market. Additionally, the fund's focus on large-cap stocks means it may lag behind in periods when smaller companies are outperforming. However, for those willing to accept these risks, JEPI has a lot to offer. Its unique strategy, impressive track record, and potential for high returns make it a standout choice for any investor. In conclusion, JEPI represents a compelling option for those seeking to generate passive income through high-yield dividend ETFs. With its robust performance, innovative strategy, and commitment to income generation, JEPI truly stands out in the crowded field of dividend ETFs. JEPI's impressive track record and potential for high returns make it a standout choice for any investor. Last but not least, we have VNQ, an ETF that specializes in real estate investments. Now, what exactly is VNQ? In the simplest terms, VNQ is the ticker symbol for the Vanguard Real Estate ETF. This is a fund that seeks to provide a high yield and the potential for capital appreciation by investing in stocks issued by real estate companies. The ETF essentially follows the MSCI U.S. Investable Market Real Estate 25/50ths Index, an index that represents the performance of the real estate sector in the U.S. equity market. VNQ offers investors an opportunity to gain exposure to the real estate industry without the need to directly own properties. In essence, it's like owning a little piece of a vast real estate empire without the hassle of being a landlord. Now let's talk about the performance history of VNQ. Since its inception in the fall of 2004, VNQ has provided impressive returns. In fact, over the past decade, VNQ has returned an annualized rate of about 6 to 7%, outpacing many other investment types. Despite some fluctuations due to market conditions, the ETF has generally maintained a steady upward trajectory. But what makes VNQ especially attractive is its consistent and high yield. It has a dividend yield that typically hovers around 4%, which is significantly higher than the average dividend yield of the S&P 500. This makes VNQ an excellent choice for investors seeking steady income streams. In terms of benefits, VNQ offers several. First, it provides diversification. By investing in VNQ, you're not just investing in one property or even one type of property. You're investing in a broad range of real estate sectors, including residential, commercial, and industrial properties. This wide exposure helps to spread risk and can provide more stable returns. Second, VNQ offers the potential for both income and growth. The dividend yield provides a steady income stream, while the potential for capital appreciation offers the possibility of growth over time. This dual benefit can be particularly appealing for investors looking for a balance of income and growth. Third, VNQ is managed by Vanguard, one of the world's largest and most respected investment management companies. This means that investors can have confidence in the ETF's management and oversight. So why is VNQ a good choice for generating passive income? The answer lies in its high dividend yield and potential for capital appreciation. By investing in VNQ, you can receive regular dividend payments that can provide a steady source of income. At the same time, the potential for capital appreciation means that your investment could also grow in value over time. This combination of income and growth can be a powerful tool for building wealth. In conclusion, VNQ offers a unique way to invest in the real estate sector. Its high yield, potential for capital appreciation, and broad diversification make it an attractive choice for investors seeking to generate passive income. Whether you're a seasoned investor or just starting out, VNQ offers a compelling way to add real estate exposure to your portfolio. If you're looking for a way to diversify your portfolio and generate passive income, VNQ is definitely worth a look. Now that we've looked at SCHD, JEPI, and VNQ in detail, let's recap and compare these high-yield dividend ETFs. SCHD, the Schwab U.S. Dividend Equity ETF, focuses on U.S.-based companies that have a track record of paying out consistent dividends. This ETF is a favorite among investors seeking a steady income stream thanks to its exposure to high-quality dividend-paying companies. It's a great choice if you're looking for a relatively safe bet in the dividend ETF space. On the other hand, we have JEPI, or the JP Morgan Equity Premium Income ETF. This one takes a slightly different approach. JEPI aims to provide a monthly income stream by investing in large-cap U.S. stocks and selling options. This strategy can potentially offer a higher yield than traditional dividend ETFs, making JEPI a compelling choice for those seeking to maximize their passive income. Lastly, we dove into VNQ, the Vanguard Real Estate ETF. Unlike SCHD and JEPI, which are focused on equities, VNQ invests in real estate investment trusts, or REITs. These trusts are required by law to distribute at least 90% of their taxable income to shareholders as dividends, which can result in exceptionally high yields. If you're interested in diversifying your portfolio and earning passive income from real estate without the hassle of property management, VNQ might be the ETF for you. Now let's compare these three. In terms of performance, SCHD has shown steady growth over the years, with a low expense ratio. Its focus on high-quality dividend-paying companies has resulted in a stable performance, even during market downturns. JEPI, with its unique approach of selling options on top of investing in large-cap stocks, has also displayed solid performance. However, it's worth noting that this strategy might involve a bit more risk compared to traditional dividend ETFs, but if you're comfortable with this extra bit of risk, JEPI's potentially higher yield could be a significant boon for your passive income. VNQ, being a real estate-focused ETF, brings a different kind of diversification to the table. Its performance is closely tied to the real estate market, which can be both a blessing and a curse, depending on market conditions. However, VNQ's high yield, driven by the nature of REITs, can make it a valuable addition to any income-focused portfolio. When it comes to yield, all three ETFs offer high dividends, but they do so in different ways. SCHD focuses on stable, dividend-paying companies. JEPI uses a combination of equity investments and option selling, while VNQ leverages the high-yield nature of REITs. In terms of suitability for generating passive income, all three ETFs can be suitable, depending on your risk tolerance and investment goals. SCHD is a good choice if you prefer stability and consistency. JEPI can be suitable if you're willing to take on a bit more risk for potentially higher returns, and VNQ could be a fit if you want to diversify into real estate and benefit from the high yields offered by REITs. Each of these ETFs has its own strengths and could be a valuable addition to your investment portfolio. So, whether you're an experienced investor or just getting started, consider these high-yield dividend ETFs as potential tools to generate passive income. As always, remember to do your own research and consider your personal financial situation before making any investment decisions. As we wrap up this video, remember that investing in high-yield dividend ETFs can be a great way to generate passive income. Today, we've voyaged through the specifics of three notable high-yield dividend ETFs: SCHD, JEPI, and VNQ. Each one offers unique advantages and potential for growth, serving as effective vehicles to help you build and grow your wealth over time. Let's recap. SCHD, or Schwab U.S. Dividend Equity ETF, is a popular choice for those who want to invest in large, stable companies with a track record of paying out dividends. It's a solid option if you're looking for a safe and steady income stream. Next, we explored JEPI, or JP Morgan Equity Premium Income ETF. This fund utilizes a unique strategy, combining stock ownership with an option strategy to generate income. It's a fantastic option if you're looking for an income-focused investment that also offers the potential for capital appreciation. Last but not least, we delved into VNQ, or Vanguard Real Estate ETF. This fund offers exposure to a wide range of real estate companies, providing a high yield and potential for significant long-term growth. It's an excellent choice if you're looking to diversify your portfolio with real estate investments. Each of these ETFs provides a unique blend of yield, growth potential, and risk, allowing you to choose the one that best aligns with your financial goals and risk tolerance. And the beauty of these investments is that they do much of the work for you. You simply invest and then sit back and watch as the dividends roll in, creating a steady stream of passive income. But remember, while high-yield dividend ETFs can be a great way to generate passive income, they're not without their risks. It's crucial to do your homework, understand your investment, and make informed decisions. Investing is not a get-rich-quick scheme, but a journey that, with patience and smart decisions, can lead you to a destination of financial freedom and prosperity. The world of investing is vast and ever-changing, but with knowledge, you have the power to navigate it effectively. So continue to educate yourself, stay informed, and make the choices that are right for you. If you found this video helpful, do subscribe, like, and share. Until next time, keep investing and keep growing your wealth.